In this video, traders, we're going to look at bearish emerging market ETFs to potentially consider. Stay tuned. Hey guys, warm welcome to you. Okay, so at the time of filming this video, the emerging markets have struggled in the prior year. So these inverse ETFs, which are on the bearish side, have performed very, very well. However, whenever you're watching this video, you're probably drawn to this because you have a bear thesis, or you click this video because you've got a bear thesis on emerging markets. And one way of doing it is to short an ETF. That's a standard ETF tracker. We'll look at that in a second. Another is if you can't short, if you're putting it in some sort of wrapper, tax wrapper, or you just can't short for whatever reason, then you can buy an inverse ETF, which gives you an inverse relationship to the emerging markets ETF. So in other words, you make money if the emerging markets go down. So let's look at those in a second. First of all these bearish ETFs are based on the MSCI Emerging Markets ETF, EEM. Now this is a big boys one. It's got 28 million at the time I'm filming this video, $28 billion, 28 billion wouldn't be that big, would it? $28 billion assets under management. And it's about the fourth or fifth biggest one out there. I think there were some slightly bigger ones, but they kind of drop off pretty quickly when you come off those sort of 10 billion level. So this is exposure to large and mid-sized companies in emerging markets. And it's kind of one of the most popular ones. It's so you can, get investment exposure to some of the bigger companies in the emerging markets. However, what we're interested in today is these inverse ETFs, which are EDZ, which is MSCI Emerging Markets triple bear. In other words, it gives you three times exposure, right? So if the emerging markets ETF goes down by 2%, this is going to go up on a daily basis, up by 2 times 3%, 6%. So you've got a bearish exposure, but you triple leverage on that. The other one we've got is EEVs, the Ultrashort MSCI Emerging Markets, and that's a double inverse exposure. And then we've got the short MSCI Emerging Markets EUM, which is just a literal inverse. I'm going to talk to you about some of the characteristics of each one of those and how much they cost to earn, how much they cost to what the expense ratio is, and how much it charges you basically to hold it. So as I'm talking now in this video date, these have been running nicely. The year to date return on the EDZ has been 20%. The EV has been 15%, and EUM has been 5%. Now you might think, well, how does that make any sense? Because it should be triple, they should be kind of exactly the same, right? But they're similar, but there's some charges involved in it. We'll get to that in a second. And they aim to replicate on a daily basis, so they're not quite the same. And that's why you've got to be very careful about some of these ETFs, especially the triple leverage ones. And I've done a video exclusively on generically triple leveraged ETFs eating into your capital. But from a kind of swing trade perspective, they're not a bad play to do. Okay, so assets under management of the EDZ, which is the triple, is a mere 97.6 million. Like I say, the 1 year performance at the date of this video is 20%, to give you an idea of how much it moves. The expense ratio of this bad boy is 1.12%, so it's not too bad. All right, let's look at the ultra short emerging markets EEV. Again, 27.4 million assets under management, so a lot less than the 96 million we had in the other one. But this is ultra short, don't forget, so it's kind of inverse. It's a funny one. It's very hard for them to get the exact exposure. They are just kind of manipulating the price so that you are actually tracking the big boy one, but it's just a vehicle of doing that. Expense ratio on this is 0.95%. And then the final one, which is EUM, the expense ratio, again, 0.95%. And the assets under management for this are 253.1 million. This uses a standard short strategy that involves replication. So the ETF basically seeks to match the inverse returns of this one, so minus 100%. So it's literally a pure inverse. So you're getting low cost access to just a pure inverse relationship with this emerging markets ETF, which is EEM. So if you don't want to short EEM, you can buy EUM and you'll just get exactly the same position. All right, guys, those are 3 bearish emerging markets ETFs to consider if you fancy the emerging markets that are too strong. You want to play this to the downside: EDZ, EEV, and EUM. Obviously, with the caveats, risk caveats associated with taking the triple and double leverage ETFs. All right, guys, take care. Whatever you're trading, keep your risk managed. I'll see you in the next one. Bye bye.